Silver just dropped 25% in a few weeks. If you're holding it, you already know. And the question sitting in the back of your mind right now isn't, should I sell? It's something sharper than that. It's whether the whole thesis was wrong, whether the rally to $90 was the story, and this is just the ending. Here's what makes this moment unusual. The price is falling, and the physical market is tighter than it has been in years. Those two things are happening at the same time. That combination doesn't resolve itself neatly. It creates a question worth taking seriously, and that's what this video is going to do. To evaluate a correction, you have to understand what you're correcting from. Silver didn't reach $90 on speculation alone. The rally had real architecture underneath it. 4 consecutive years of supply deficits, where mine production and recycling couldn't keep pace with consumption. Industrial demand compounding from solar panels, electric vehicles, and AI data centers, all of which require silver in ways that don't have easy substitutes. A weakening dollar making the metal cheaper for buyers outside the US, and a geopolitical environment that kept sending investors toward hard assets as a hedge against things getting worse. Each of those drivers had a physical, traceable anchor. This wasn't a meme trade. It was a confluence of real forces that had been building for years, finally showing up in price. But parabolic moves, even structurally justified ones, always correct. That's not a market failure. That's how markets process the gap between where price is and where it overshot. The question was never whether silver would pull back from $90. The question is whether anything that mattered has actually changed. Most people interpret a sharp price drop as a verdict. The market spoke. The thesis was wrong. Move on. That's usually the wrong read, and it's especially worth questioning here. The macro picture right now is genuinely murky. Non-farm payrolls just came in at negative 92,000. The labor market is cooling. At the same time, CPI is holding near 2.4%, and PPI came in hotter than expected, meaning inflation isn't falling the way the Fed needs it to. You have a slowing economy and sticky prices at the same time. That combination makes investors nervous across the board. When uncertainty spikes, the reflex is to reduce exposure. Commodities, equities, risk assets generally. Silver sells off not because the silver thesis broke, but because the portfolio manager needs to raise cash or cut volatility. Sentiment-driven corrections and structural thesis failures look identical on a price chart. They are not identical in what they imply for what you do next. Here's the genuine question worth sitting with. When a market corrects 25%, is that the market telling you the thesis is broken? Or is it offering you a second entry at a price you thought you'd never see again? Don't answer that yet. The answer depends on what's actually happening beneath the surface. And that's where this gets interesting. There's a figure that most retail coverage of silver skips entirely. It's called COMEX registered inventory. COMEX is where silver futures trade in the United States. The exchange holds silver in warehouses, and that stock is divided into 2 categories. There's total inventory, everything sitting in COMEX vaults, which currently stands around 331 million ounces. And then there's registered inventory, the silver that has actually been certified for delivery against a futures contract. That number is approximately 76.5 million ounces, and it has been dropping sharply. That distinction matters enormously. When someone holds a futures contract and decides to take physical delivery instead of rolling the position, the exchange must fulfill that obligation from registered stock. Not total stock, registered. In early March, delivery notices exceeded 50 million ounces in a compressed period. Against a registered base of roughly 76 million ounces, that is not a rounding error. That is a system operating with very thin margin. When demand for physical delivery is high and the deliverable supply is shrinking, the risk of a short squeeze, where sellers who don't have the metal scramble to cover, becomes structurally elevated. Here's the important distinction to hold. The price fell by 25%. The registered COMEX inventory did not recover. The physical tightness did not ease. The correction happened in paper markets driven by macro sentiment. The underlying physical reality moved in the opposite direction. That divergence is unusual, It doesn't guarantee a reversal, but it changes the analytical weight you should give to the price drop as a signal about fundamentals. The industrial demand case for silver is real. China posted record silver imports in the first 2 months of 2026. Solar installations globally are continuing to grow, and solar panels use silver in their photovoltaic cells in ways that remain difficult to engineer around at scale. AI data centers add incremental demand through electronics and conductivity requirements. The Silver Institute's projections point to continued strong structural demand growth through the end of the decade. This is documented, traceable end market demand. It's not a narrative, it's procurement data. But the honest version of this story has a complication. At $90 an ounce, manufacturers started looking for ways to use less of it. Thrifting, reducing silver content per unit, is a real phenomenon, and it's been happening in solar manufacturing. Some applications shifted partially toward copper where the technical trade-offs were acceptable. High prices create substitution pressure over time, especially in industrial applications where engineering teams are explicitly tasked with cost reduction. So the demand story is strong, but it is not immune to price. There is a level at which the industrial case gets tested. $90 was starting to reveal that level. Here's where this becomes a question you need to answer for yourself. Do you believe the green energy build-out is real, durable, and still in early innings? Because whatever you believe about solar and EV adoption is already embedded in how you should think about silver's demand floor. If that build-out is real, thrifting is a near-term friction, not a structural reversal. If it stalls, policy shifts, economic slowdown, technology change, the demand thesis needs to be reassessed. That's not a rhetorical question. It's the hinge the whole industrial argument turns on. The macro backdrop for silver right now is best described as permissive. Not actively supportive, not fighting the thesis, permissive. The dollar index is sitting near 99.6, soft and relatively stable. A weak dollar removes a headwind for silver, which is priced in dollars globally. When the dollar softens, the metal becomes cheaper in euros, yen, and yuan, which supports demand from buyers in those currencies. That's a mild tailwind at current levels. Real yields, what you actually earn on the 10-year Treasury after inflation, are running around 2%. That's not negligible, but it's not the crushing weight of 2022 when real yields were spiking and precious metals were being hammered. Moderate real rates mean silver doesn't face strong structural pressure from the opportunity cost of holding a non-yielding asset. This is neutral to mildly positive. The Fed held rates at 3.5% to 3.75% in March. Powell acknowledged progress on inflation, but characterized it as slower than hoped. No rate cuts are expected in the near term. That removes one tailwind, the anticipation of easier money, but it also signals the Fed isn't tightening further into a weakening labor market. The economy is in an ambiguous zone, and history suggests that ambiguous zones keep precious metals relevant as hedges without requiring them. Geopolitics adds the wild card. Tensions in the Middle East, specifically around Iran and energy routes, are creating oil supply risk. Higher oil feeds inflation expectations, which feeds safe haven flows into precious metals. This is episodic rather than structural, but it's real, and it adds a floor of anxiety that typically supports silver. Put it together. The macro environment isn't providing a catalyst for silver right now, but it isn't the headwind either. That means the fundamental and physical case has room to operate. This is not a forecast. Markets that are this volatile in a macro environment this uncertain don't reward confident predictions. What they reward is a conditional logic structure, knowing what you're watching for and what you'll do depending on what you see. Scenario 1. Technical support at $69 to $70 holds. Silver stabilizes and begins printing closes above $70 on meaningful volume. COMEX registered inventory continues declining or plateaus at historically low levels. Macro volatility stays range-bound without a sudden dollar surge or equity collapse. In this path, The correction was a painful but temporary shakeout, sentiment-driven, not fundamental, and current levels represent a reasonable accumulation zone for investors with a 12 to 24-month horizon. The instruments are straightforward. Physical bullion for direct exposure with no counterparty risk, SLV for easy liquidity, SIL for leveraged exposure to miners that can move 2 to 3 times the metal's percentage swings. The leverage in miners is real. It works in both directions. Scenario 2. The $68 floor breaks. Risk appetite deteriorates broadly, from an oil shock, a sharper-than-expected economic slowdown, or a sudden repricing of Fed policy. In this path, silver's next technical support is meaningfully lower, and buying into the correction too early becomes a costly error. The fundamental story doesn't change, but the timeline extends, and the pain in the interim gets worse. The conditions that separate these scenarios are visible. Watch whether silver closes consistently above $70 with volume behind the move. Watch COMEX registered stocks. If they start recovering, the physical squeeze narrative weakens. Watch the dollar. A sharp DXY breakout above 102 would be a headwind worth taking seriously. Watch the broader risk environment. Silver does not move in isolation. Ask yourself right now, which scenario are you positioned for? Not which one you prefer, which one does your current position size actually reflect? If you're fully loaded expecting scenario 1, but scenario 2 is equally plausible, that's not a thesis problem. That's a position sizing problem. And those are two very different things to fix. Silver's situation right now is a collision between two realities moving in opposite directions. The paper price corrected sharply. The physical market tightened further. One of those realities will eventually pull the other into alignment. That resolution isn't written yet, but the investor's job at this moment isn't to call the bottom. It's to size correctly for the uncertainty, stay solvent through the volatility, and give the fundamentals enough time to do their work. The structural case, the deficits, the COMEX inventory, the industrial demand, the macro backdrop that isn't fighting the thesis, that case hasn't broken. It's just being tested by noise. Patient capital, properly sized, tends to be the thing that's still in the game when the noise clears. This video is for educational and informational purposes only. Nothing here constitutes financial advice. Every investment decision carries risk, and that risk belongs to you. Do your own research before acting on anything you hear.